Sandip Sabharwal, good morning. Uh, are we now really reaching what could be called as the end of the pain? Because dollar has stabilized, yields are not rising, war is getting over, and US tech stocks have started correcting. So whatever has bothered us, now one by one is getting addressed, excepting Donald Trump.
See, Nikunj, every day's announcements of Donald Trump's cannot have the same impact on the markets. So you cannot have a scenario where every day uh, US president says something and the markets fall just because of that. Uh, Given the fact that most countries which are actually most impacted by the tariffs and who are so export dependent have actually seen their markets move up. So I think it's just the explanation of what happens, which is not the valid reason. Now, the key points, the main concerns of people for emerging markets, including India, beginning of the year were US dollar is continuously rallying, so US assets are getting bought. Secondly, US bond yields are moving up, so they become more attractive. And that's the reason why emerging markets are seeing outflows. Now we are at a stage where recent data indicates that the US economy seems to be suddenly slowing down significantly. So, in that context, we've seen the US dollar index actually fall 2% this year, not rise. We've seen bond yields cool off significantly. And today, US is 70% of the world market capitalization, up from maybe around 30% a few years back. So the funds will shift. Now, whether the funds shift more to bonds or more to equities in other markets, including emerging markets, is something we need to see. But I think that extreme fund flow picture where just US and assets were being bought, including other developed equities like European equities, despite there being not much growth there, I think that phenomena might not sustain. In the Indian context, I would think that most of the negatives, at least for large caps and established mid caps, is in the price. Now it's just a liquidity thing that there are some people who are doing loss harvesting. There are people who have no conviction that markets will rise, etc. But markets have these phases, and uh, I think that should get over sooner than later.
Reports which are pretty much saying the obvious, which is that auto stocks like Mahindra and Tata Motors, they've got sold off on fear that Tesla is going to will have an impact on the Indian auto space, and especially companies which have exposure to the EV space. Let's look at reality, something which we've been discussing, that right now there is 110% duty on Tesla imports. If import duty is slashed to 15, which is what the media reports have been indicating, Tesla prices, even with that 15% duty, will be in a different kind of an bracket, which is that the ex showroom price for Tesla, considering what the global price is, would be above 40 lakh rupees. Above 40 lakh rupees, the market size in India is called as the luxury car. And Tesla, if comes to India, will have to compete with the luxury car market, not with the current prime portfolio of Mahindra and Mahindra or Tata Motors, because their large EV sales or large sales are under the 40 lakh category, which is what the differentiating factor is. So both CLSA and I think Nomura has come out with a report where they are making a case that buy into autos as the Tesla fear is slightly overdone. Sandeep, is this a good idea? Revisit Mahindra and Mahindra or Tata Motors, because anything which is sold off because of fear of Tesla, that is that is slightly stretched.
It's stretched because, like you rightly said, they will be getting some duty concession on first 8,000 units if they commit to spend whatever 4,500 crores in setting up a manufacturing facility. There has to be a service network for people to be confident while buying a car. I think some people might just buy a Tesla just to show that they have a Tesla. But except that, I think the value proposition as well as the established service network, everything needs to play out. So obviously these fears are over exaggerated. I think one segment which should see a recovery going into next year, as far as consumption basket goes, should be the auto side. So I would agree that companies which have done so well and where their outlook is also is so good, especially Mahindra and Mahindra. I think the sale is exaggerated, and the sale started actually just one day after their new models got some 8,000 crores of demand on a single day. So I think it's irrational in that way.
Sandeep, within banks, which really seems to be the go-to right now from any market expert that we've been speaking with, both in terms of valuation as well as growth trajectory, would Federal Bank feature on your list?
Especially in banks, I don't go too much below the top four, five. So because in banks, it's the asset quality which is the only thing which matters, and asset quality is easier to track in larger banks rather than in smaller banks where suddenly you can get hit by something or the other. But that said, Federal Bank as a private sector bank has been doing well. So in terms of their strategies and whatever growth and asset quality they have reported over the last few years. So it could be an opportunity, but I specifically don't buy those banks.
Sandeep, your thoughts on Geo Financials and Zomato, the two new age companies are going to be making way in the index, and BPCL and Britannia out.
It's unfortunate that in India, the index changes of premium indices happen so frequently. It doesn't happen anywhere else in the world. So that you keep on changing the indices so frequently. And the only criteria seems to be some statistical criteria on market cap, volumes, etc. While these companies have no real trading history, Geo Financial has no real business to actually talk of. Like it's just starting off on its businesses. Zomato was deep into losses till last year. Even now, with the investment into quick commerce, we don't know what will be their profitability trend. So I think these are not good measures actually, and they artificially inflate the Nifty P because you are removing profit-making companies with a relatively lower valuation and getting it companies with not too much of profits. So I think it's a bigger debate how index composition should be, but then I don't think it's a good move. But then they do get in passive money in, so I think significant passive money will flow in when the index changes happen end of March. So they will obviously gain due to that.
There are some positive brokerage notes highlighting that IT space is the place to be. And Sandeep, just wanted your take on the IT space overall. How do you see the demand shaping up? And at this point in time, do you believe that IT is the safe place to be?
Not really, because the recent economic data coming out of the US as well as growing uncertainties related to trade, etc., is creating a sense of uncertainty within the US economic landscape and corporates. So it could impact IT spending in the near term. So I think we need to be watchful of that. We've seen in the past that IT demand suddenly collapses in uh, contrary to some management expectations whenever there is uncertainty. So I think this is a sector where we need to be cautious at this stage.
Okay, caution on IT. Sandeep, good to have you on the show as always. Thanks for your time.